Somebody asked me on Twitter, they're like, what's your thoughts on the government shutdown? I'm like, well, it's not really going to affect markets, so I don't really care.
They've made the decision. If we're ramping into Q4, there's no slowdown into election next year. And they're going to have to pull out all the tricks. We might be coming out of a recession, inflecting economically over the next 6 months.
Man, like you look at the whole macro fundamentals right now, and it's like, I'm bullish.
If that line ever drops into the red zone again, this is going to be a full-on like euphoria tech bubble.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, what's going on, everybody? Welcome back to another episode of the Roundup edition of Forward Guidance. You got the trio here once a week. We're getting into the groove. It's October 2nd. October has begun. What's going on, fellas?
Happy Uptober, or as Tony Greer calls it, Rocktober.
I like Rocktober too.
We're going to rename this podcast the Ponzi. Ponzi.
Ponzi.
People already blackout drunk now.
Yeah. We're actually going to do, we talked about this. We're going to do a power hour. I don't know if this is dating me in college, but we're every minute we're going to take a shot of beer for a minute. What was that next week? We're going to do a forward guidance power hour.
The first time I did that in college, we were like, a shot of beer, that's nothing. Like every and then you do it by like shot 40, you're just jumping up and down.
They call it like
okay,
too.
Beer works.
Are we doing it next week, or are we going to do it 2 weeks from now?
Well, we'll be in DAS. We'll figure it out.
Okay. Maybe it might be end of month. It might be a Halloween thing.
We'll figure it out. But that's a good segue. DAS is coming up 10 days or something like that. So get your tickets. It's going to be a lot of fun. I got a discount code. Forward 200 will get you £200 or 200 quid off. My mom's British, so I know that one. It's going to be sweet. We're tapping in Michael Howell here for Tyler. So that's like I said last week, big shoes to fill, but we pull in the big guns.
I could pull off. Look, he kind of looks like me. Just a little bit.
That's what you're going to be looking like in a few years.
He's got the old distinguished gentleman thing. If I age like that, man, I'll feel good.
You're looking good. Yeah. But yeah, guys, get your tickets. It's going to be fun. We're also going to be doing a podcast meetup as we do. So Tuesday night, we're going to be doing a podcast meetup. I think we're doing it in conjunction with OX Research, the Blockworks Analyst Research crew. So there's going to be that too. So yeah, lots happening. Should be fun. Get your tickets. All right. Housekeeping over. What's on your guys' mind, guys? The government shutdown. I had to make it mean. In light of recent weak economic data, we will be shutting down the government to stop the FUD. So, it wasn't enough just to fire the BLS commissioner because of the bad jobs report. Now we're not even getting the jobs report tomorrow. Like normally this part of the month, it would be me doing the whole thing, the whole spiel about the NFP data, but we're not even getting it, which is just, I don't know, that sounds like a Ponzi to me. Sounds pretty bullish to me.
Well, in their defense, we did print like 3.8% GDP print, so wasn't all bad.
That guy that they appointed actually to take over BLS, they retracted his thing.
EJ Antony. Yeah. So now
Yeah.
I don't even know who's going to be the head of the BLS. We don't have a nominated BLS commissioner, and now we just don't have data. So stocks go up, gold goes up, Bitcoin goes up. That's where we're at.
I thought it's hilarious that government shuts down and everyone just like, the government's such a pile of garbage. Like, it's better for everybody. Stocks just go straight up. People are just like, it's so ironic.
Hey,
it's like,
don't say
no
that. Hey,
connection.
there's a lot of important government workers out there for sure. But I know what you're saying. I will say this. I think it's a bigger macro theme, which is moving more from the public side of things to the private side of things. What's really interesting is like, I remember 10, 15 years ago when there was like the fiscal cliff and the government shutdown and all this fear. And now the derivatives market just they don't care. Like, it's like that doesn't move the needle at all. Everything's going to still keep moving the same regardless.
I 100% agree. Like, somebody asked me on Twitter, they're like, what's your thoughts on the government shutdown? I'm like, well, it's not really going to affect markets, so I don't really care. I mean, if anything, it's just going to be no bad economic data coming out. So I don't know. Seems fine to me. And that's
cruise control, baby.
We're on cruise control. It's just up only. Yeah.
I think part of that is it's so far down the list of like government intervention into markets that before people were like, wow, government shut down. This is like a big deal. Now they're manipulating the money supply like every other day ending in Y. So it's like, oh, what's a shutdown? Like, this is like,
it's also so performative. Like, I think we know it's going to shut down for like 2 weeks, maybe tops. I don't know. So then they'll come to an agreement and everything's kind of pre-negotiated anyway. And they act like, it's a big deal.
Yeah.
2 weeks.
100%.
Vacation.
But in light of that, there is still private payrolls that we got this week. So I will mention that. So we did get the ADP data, which is private payroll. So this doesn't include government payrolls. It's done by private company, not the BLS. And that came in quite negative, negative 33,000, I believe, jobs, as opposed to the forecast at 50,000. So not great. So there is still validation of this weakness in the labor market, but it's just this weird continuation conundrum of you have this artificially weak labor market. We don't need to beat the dead horse of why. We've talked about why. It's immigration. It's changing of the labor force dynamics, but it's still setting us up for more rate cuts. What do you got, Tyler?
It could be one more thing. Check out this. This hit me with slide 44. Slide 43. I saw this from Robert, the Infonomics guy who's puts out good stuff. Total job openings are dropping. The S&P is going to all-time highs, and ChatGPT is like this Maginot line. And we could be seeing, I think this might be saying productivity boom, where, we're seeing unemployment go down as AI keeps scaling. Could this be the productivity boom? I don't know, but it's worth pondering.
I don't know, maybe partly. I mean, yeah, what you're looking at here is like JOLTS data, and people have been tracking, like if you look at real-time Indeed's job postings, it is like a leading indicator of where job openings is going. And for sure, one of the biggest changes in Indeed job postings has been like software developer job openings have just absolutely plummeted. So yeah, I feel like it's partly that. And then also just the macro picture. Like, this was one of the big reasons why they hiked so aggressively in 2022 is because they knew they had so much slack in job openings that they could hike and let the labor market rotate into just having less job openings without the unemployment rate spiking. So yeah, maybe a bit of both. I don't know. I've also seen some really bad chart crimes where people are saying that this is like a really bearish chart because the S&P should be following job openings down, which is just hilarious to me. So I'm glad that wasn't the takeaway here.
I just have to say this, as an anecdotal nonsense, idiosyncratic thing. I go on Grok all the time now, or ChatGPT. Like I sat in the car with my kids and I was like, hey, Grok, let's play a 7-minute game for kids who are 7 and 5 years old on this last 10 minutes of the drive. And Grok made up a game on the point of how we could play. Like, who's like, guess what, animal sound this is? Like, and I'm like, that's incredible. First off, think about it. And then I went from that to, during my job, it was like, categorize X, Y, Z, blah, 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 spits out like a master's degree level, report on certain things that is probably better than most sell side research. So I don't know. I'm kind of in the camp of we're heading into dystopiaville and we better watch out here and pay rather than call, I think a lot of people are calling BS, it's a bubble, et cetera, which I can wrap my head around too, but I'm seeing like real tangible things here.
I feel like it's going to be a fork in the road where it's either one subset of society is going to go just like full AI slop Instagram reel. Like you saw the new ChatGPT video feature came out this week, and it's just like, all right, cool. We're just going to have hyper optimized AI slop video content forever. But then there's other parts of the society where I think it will be like a meaningful productivity tool. And it's just trying to navigate which way we go from there.
Felix, I put some slides on 11. If you start there, I thought there's some interesting labor data. I mean, AI, no AI, the labor market's definitely weakening. I tend to believe it's more of a function of the two-speed economy than it is about AI at this juncture. Like, I think that maybe a little bit, but I think the dominance is just, you're still seeing it in these surveys too. Sentiment pretty bad relative to historical precedent. So this is job openings per unemployed worker just fell below 1. The next slide is basically the Consumer Conference Board jobs fundable minus hard to get, and it usually correlates. Like, this is a more sentiment fear kind of index, which is pretty telling. I think there are nuances though in terms of why the traditional markers aren't following. The next one shows, we've been talking about this for a while, how bad it is for youth unemployment in particular. This shows at the bottom the cohorts, the changes. If you look, 20 to 24 and 16 to 19, not those huge jumps out of the labor force. So it is very unequal. And the next one is also highlights this for the 20 to 24 and 16, 19. So the youth unemployment, we kind of know it points to the worst market for new college grads.
That is so mind-bogglingly bad to me. Like, if you get out of college with like student loans and you can't find a job, like, I get how angry you'd be.
What's the funny Ponzi angle to that too? It's just the way we measure unemployment is that when disgruntled workers exit the labor force because they've given up on seeking a job, that's no longer considered unemployed. They're just not part of the labor force.
Yeah. There was some stats that came out. 50% of parents, 50% of children are financially supported by their parents. The most since the Great Depression, kids live with their parents. And I think it's a third of all down payments for first-time home buyers are coming from financial support from parents. Like this, we talk about this nonstop, and the data just like couldn't be more clear. I think part of it has to do, like, put the boomers aside. Part of it also does have to do probably with like this lie that was sold to people that everyone should be a white collar worker, and you have, everyone paying hundreds of thousands for liberal arts degrees and coming out wondering why they can't find a job. Meanwhile, the snowplow driver and the UPS delivery guy are getting 15% raises year over year. And that imbalance is being exacerbated by the immigration thing, which is like fine. Like, there's good, like, but it means inflation over the long term. Cyclical, there's still downward pressure. But the ideal world is that over time, the lack of the immigration reduction brings lower class wages up to a point that is quote unquote acceptable for Americans to take the jobs. And then everybody on a per capita basis, you're better off because you don't have this huge cohort of the population who's kind of disenchanted. So it might work. I mean, I do think rate cuts help that side of the spectrum, but we still need to see it.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. And this is a good segue into something I sent to you guys this week, but Michael Howell did this really interesting analysis looking at this chart. He did a regression of this. So just looking at the price of gold to fertility rates in the world. And it's sort of this, I think the correlation between, and he gets into this in a second, is just really this idea of monetary inflation bringing the price of assets all higher, real estate, et cetera, which makes it a lot more difficult for families to start because they can't even afford a house to be able to start that family within. So he did this really interesting analysis, just looking at how, as the price of gold increases in advanced economies, the fertility rate drops at like an R squared of 0.74. So fancy way, but the simplified version of that is soaring gold prices are a symptom of the same monetary inflation that drives up housing costs. Higher housing costs force people to have fewer children. The resulting demographic decline prompts governments to encourage immigration, which can cause social tensions and require even more government spending, perpetuating the cycle and accelerating the decline of the West. The solution is sound money, not more government intervention. And then you have a couple other charts too, just looking at the third variable, that inside variable, which is just the house price to income ratio. So getting at this idea that they just don't have meaningful real wage growth. We talked about this last week about how the Fed is basically built to make sure that this doesn't happen effectively. So as they can't afford houses, the fertility rate drops. And then the last one here, just looking at how the result of this is a vicious spiral of low productivity, low fertility, poor social fabric, high taxes, soaring housing prices, populist politicians, and ever larger debts. And it's just, it's fascinating.
So good. Like, how come, my first question is, how come more people aren't doing work on this? Like, this is the biggest issue in the world, having a baby bust. And the fact
because
that
then we need immigration to come in and cover things. And then you have like the political tension we're in now.
Yeah. Because it falls out of the purview of the 4-year election cycle.
Yeah. And the only time you get like a millennial or Gen Z and below perspective is if you go to a podcast.
Cool. There you go. Well, Except for Michael Howell, he's older, but he gets it.
Dude, he gets it. That's a guy who plants trees whose shade he'll never sit under. That's a guy who gets it.
I like that.
It doesn't end well. But the problem with this, by the way, is just we saw it in April. The solution, they tried doing this. They tried flipping spending from public to private. They tried cutting the deficit. They tried politically unpalatable.
Now you got to just grow your way out of it. I got a great chart for this. Hit me with this is one of my favorite charts to look at, 46. My boy Capital Flows brought this up. Great guy. Yeah. Highly recommend.
Friend of the show. Good dude.
So this is something just to keep always in the front of your mind. This is the 2-year nominal bond yield. That's the white line versus the 2-year break-even forward inflation. So that's the orange line. And so when you have this, so during 2020, 2021, 2022, you had negative real rates, meaning the inflation 2 years out was higher than the nominal bond yield, which means everyone was piling into, risky assets. We're not even at the point where we have negative real yields yet, but we've been in this downtrend since about mid 2023, which, as that trend line comes down, and you're trying to grow your way out of the economy using inflation to delever the economy. If that line ever drops into the red zone again, this is going to be a full-on like euphoria tech bubble again. And it seems to be going that way because that's what the policy is essentially, I think they're trying to do, is 130% debt to GDP. They need to get that lower so the deficit goes down and, we get on some sustainable path. But this chart really says it all. It's like you could probably run an entire portfolio off this. It's like buy bonds when this is really, steep on the green, get into everything else if the trend is going lower. Just go buy the dumbest, most levered, riskiest, high short interest companies when this is dropping.
That's been all year, basically.
Yeah.
It's all
and you know what?
It feels like it's going to continue on a bit here. I mean, I'm curious. Let's shift into some of the market structure stuff. I want to tie in a couple of slides around. We've talked about this emerging TGA rebuild situation after the debt ceiling got resolved, and it is complete now. So you can see here, this is from another friend of the show, Conks. Always, one of the best on monetary plumbing. Always go follow his work. He's the man. And you can see here, so we've had that rebuild of the TGA that occurred. We got to that $850 billion level. We saw a little bit of a hiccup in rates on the monetary plumbing side of things here in like the last week of September. It's a lot of the end of year fiscal flows, tax flows for corporations and that sort of thing. So it is really interesting to see the price action where it felt like the last week and a half of September was just very, very sluggish. We talked about it last week. We're just like, man, like you look at the whole macro fundamentals right now, and it's like I'm bullish. You're seeing gold do well, but Bitcoin's been pretty lackluster, and there's a few different confluences that have come together that are really just piquing my antenna right now. Which is that okay? Right as that TGA rebuild finished, right as end of year fiscal flows, tax flows were being finalized as well, you started to see Bitcoin bottom. And then it's still this, we talked about this last week, how, we were dipping in there and starting to buy Bitcoin at like 109K because it just didn't make sense to be that artificially weak when you looked at everything else. You look at what's going on, like gold and Bitcoin, right? Like gold's just been up 15% and Bitcoin's been pretty sluggish. And then lo and behold, the local low of Bitcoin was this headline hits the tape. I think 4 hours after we recorded last week. And it's unusual trading ahead of crypto treasury deals draws scrutiny from US regulators. So, this is just beautiful. You have threats of insider trading from these digital asset treasury companies. So what do those insiders do once they get a knock on the door from the SEC? They go and sell their crypto based on this inside news that they're being investigated for insider trading. And the second that headline hit the tape, we bottomed. And then now we've just been ripping ever since. We're almost at all-time highs again. So it's just absolute cinema.
You got to love that, where when the macro is playing out and it's disconnecting, crypto is disconnecting from the macro, there's something you don't know. And then when the headline hits, you're like, oh, bam, that's what it was. Let's buy them.
It was perfect.
Now that the macro is all lining up, it's really hard not to see daylight here. Even the vol characteristics of the corn are very salubrious, meaning like if you look at other parts of the market, like the AI names, you can see there's a steep call skew, whereas that's not necessarily true in spot crypto here. So I don't know. I feel like it has legs, but you don't want to get too cocky here.
Quinn, you got some bullish emojis in your name there. What's your read? What's going on?
Yeah, these are the Aeon emojis.
Has Quinn flipped? Has he flipped?
I'm pretty bullish. I think that the economy was in a recession / is in a recession since 2024. I think it's a weird market, man. Like I'm still wrapping my head around how to explain this period since 2024 we've been in, where like the quote unquote liquidity cycle's been elongated. A few things I just point out though is, and I called this out in the beginning of the year, I should have been more bullish post-Liberation Day. These oil deals that are crushing the price of oil are giga bullish. Like it just eliminates 2022 type scenario off the table in the near term. And these front end rate cuts, like we're getting this labor data that we all can see has been weakening for a long time now, and is maybe at its weakest point. But part of that is the economy, part of that is immigration, but they're cutting. Like 2021 ended when they turned hawkish. The Fed stopped inflating the bubble, and cuts are in perpetuity. Balance sheet stuff is probably coming into play later this year, from the Fed side in terms of ending QT, maybe the Treasury maybe as well. It's a hard thing to evade. Like I struggle to see what the negative catalysts are, and
see that makes me nervous.
The unfortunate thing for crypto people is that the bubble is in AI. When 2021, crypto people had it really lucky because the bubble was in our industry, and you could be a blind monkey throwing darts and pick the thing that was going to 5x. The bubble's in AI now, we're firmly in bubble territory. I mean, look at every valuation metric. Look at every the concentration, 40% S&Ps in 7 companies. This is a bubble. Not every bubble has to look the same. This is a bubble, in my opinion. Yeah, and just like the plate's still spinning, so you have to play. And I think the one thing that I think is interesting is there's going to be some assets that I don't think necessarily the assets that performed in the last 3 months are going to be the winners of the next 3, because I think it's going to be a different environment. For example, I think small caps lead Mag 7. I think Bitcoin outperforms gold. Gold might be locally topping here for a week or 2 or 3 or 4. And also within crypto, I think there might be some different leadership changes. But yeah, it's hard to fade, man.
Here's my contra on calling it a bubble. Go to slide 45, and I put this on Twitter too, but this is the total amount of money in money markets, $7.31 trillion. So like, it's really hard.
Why does this prove it's not a bubble?
Maybe the bubble
is defined as valuation.
This is no, you know what this is? This isn't people selling equities to go in money market funds. This is just the other side of the ledger of all the interest payments from the government. It's just it's high interest payments, and it's going to people in money market funds. I mean, maybe it provides fuel. Like if these money market fund holders take some of that they're getting, 4% every year or whatever we're at right now, and rotate in equities, I can see that being compelling. But I don't think it's people selling equities to go into money market funds. Is that what you're saying, Tyler?
No, I'm saying like this is a cash bubble, meaning people are overly, they're going to be forced out of money market funds as rates come down and you have to rotate into risk assets, especially if bonds become like there's starting to be drumbeats that we've been talking about this for a year now, but why the hell would you own a bond? I saw my first article where JP Morgan said something like, who's going to buy all the treasury debt? And it was like, yeah, that's what we've been asking for a while. It's like when you get into this Wymerica type thing where it's a race for storage collateral, like stores of value. That's what this is right now. We're watching a generation of poor fiscal decisions come home to roost is my read here. And from that perspective, like what is debt? Maybe the bubble's in debt and it's not in AI. Maybe that's just where it's all going to go. When debt is meaningless, where do you go? Right? Like, I don't know. That's just my dumb brain. If they have any ounce of monetary, I guess, austerity, my tune would change considerably, and you'd probably see it in the credit spreads. But like we always go back to is like credit spreads are so low. You could finance a pile of dog shit right now and say, hey, why don't you I'll borrow at 6%.
But no, Tyler, so your point about how your tune would change if there's austerity, I want to bring up this news that just hit like 2 minutes ago while we were recording. So Trump was being interviewed and he says, considering taxpayer rebates of $1,000 to $2,000 using tariff money. So that just hit in the last 5 minutes. Like
that's more lightning fuel. That's
just, like, man.
But the policy is to grow your way out of the debt. It's a wartime policy of growing yourself out of the debt. And that's just what it is. And people are still shocked. And I think this is, until you see the surveys, the AAII just came out, bull surveys are barely ticking higher and the market just goes up every day. And so you got to see the euphoria, like, and I'm sensing it's starting, like it's definitely starting. I just don't know what derails the credit bubble, because like now you're going to get the reach for yield type crazy behavior in high yields, where like high yield's doing really well and more money is going to go allocate towards it, which means you can finance crazier and crazier stuff cheaper and cheaper and cheaper, which means equities, if you don't have to dilute your equity and issue equity, that means your equity squeezes. So it's a capital structure game at this point. And I just wouldn't, it's really hard to call a top here until you see like someone who's getting really wealthy pumping their bags. When you start seeing screenshots of people like, or the mother-in-law indicator where it's like, hey, I heard about this Bitcoin stuff. Can you tell me more about it? Like that. Then I'm starting to hear those, but it's not.
What about Chamath relaunching a SPAC this week?
That's definitely on there.
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Is this your chart? Somebody put a chart in here about this, but you can see the lower red line is starting. Yeah, it's starting to come back.
So we're having Hunter Hopcroft on in like 2 weeks to talk about the whole market structure dynamic from like a very academic standpoint, not just us morons, but like he really nails this. He'll nail this even better than me. But the reason why we've seen no equity supply is, obviously buybacks, but also the market doesn't want your middle market, good growing 20% a year CAGR. That company is going to the private debt markets and borrowing debt. They're not going public, but you're getting the crazy there's a company that has zero, it's like $11 billion market cap now and has zero revenues. And you're just like, okay, that's a little euphoria. So like there's definitely things to be concerned about, but until you have the overwhelming supply of IPOs and equity, and like we're starting to get it, but I don't think we're there.
Okay, I want to game out with you guys live here the scenario that, okay, if the midterm play is for them to basically take all that tariff revenue and just give it back as stimmy checks into the midterms, get people all happy and everything, like how do you plan that out? Because that for me says, all right, we're going to have wider fiscal deficits than what is priced in, probably bearish bonds, bullish equities. What's Quinn, what's your read on that, if you think that's where we head?
They, without question, are going to do fiscal next year. I mean, that is top priority for an election year. We all know that. Like, okay, so however it looks, I guess you have to follow where that money goes to, and what that is. I mean, we saw the last version of helicopter money in COVID that went straight into everybody's Robinhood accounts, and you're doing it at a time when youth unemployment's rising, so all these people are in their parents' basements again. So, dude, I would probably play it the same way, but real GDP is going to print a 3 handle for Q3. I mean, this is not, there's no recession in sight. And so, you basically just, I guess, until bonds become a problem. But the interesting thing is that two things. The immigration has certainly put downward pressure on the economy and brought yields down. That, by all accounts of interpreting the market, kudos to Bessent and them for this one. Like, the market is loving this and taking this as a huge win, where you look at yield differentials for the US versus rest of the world have come way, way, way down. Like, the people would say our bonds are way too rich relative to the rest of the world. So that is, if you're the, as he says, I'm the world's top bond salesman, that's a job well done. And then the second thing I would say is this rebalancing, where we saw from the BLS data where the K-shaped recovery, small and middle, there's been a recession for Main Street for the last 2 years, basically, paired with the oil deals and, potentially maybe deregulation that's unlocking housing prices and things. They actually are, like, this monetary pressure that they're putting on is not causing goods and services inflation. The caveat that this month will be the highest print of the year, most likely. A lot of that has to do with base effects. Inflation will probably rise this month, kind of flattish next month, and then kind of tick back down December, Jan type of thing. And the market, that's probably already priced in. Everybody knows it. Maybe we get a spook around the October print if we get it. The policies are kind of working for the markets. I'm not saying,
yeah,
this stuff I've been saying, I'm from the Midwest. I pretty blue collar roots. Like there's a lot of, I don't mind tariffs and immigration as ways to deal with some of the problems facing the country. Messing with money supply is not a good one for the long-term prospects and, all the lower class and things. So I don't agree with that. And that's the thing I dislike the most about this administration. But to be frank, there's probably still ammo in the Treasury's toolkit. Like they haven't done the Yellen ATI to some crazy extent yet. I mean, it's coming eventually. So I feel like Besson's probably sitting there thinking, okay, we've navigated this. We're at all-time highs. We've got the Fed moving. They're going to cut 2 times by Jan, 3 times by April. That's probably fine for the economy. And, roll the dice into the election year with some more fiscal. And if we need to come, Q2, Q3 next year, have to do some Treasury stuff to calm a real rate scare. They're probably game and markets cook on from there. So
that market sounds awesome.
I the reason I got Q1 so right was because I listened to them and gamed out what I would do if I was him. And that's exactly what happened. I got the magnitude of the pivot wrong, but they're going full bore on this. Like they've made the decision. If we're ramping into Q4, there's no slowdown into election next year. And they're going to have to pull out all the tricks. There will probably be some great times to short bonds. I don't necessarily know if right now is that time with oil falling through the floor. But yeah, when you it's just like globally, I mean, Europe's inflation rose and their funds rate's already at 2%. You know what I'm actually bullish on here? USD. I think dollars. I think the narrative, I'm saying this coming from someone who is 1, bearish, 2, I call it like it is on Trump and Besant. Like everybody knows my political views from last year. I've critiqued the hell out of them this year. So I'm just saying how the cards are falling. I would not be surprised if the narrative flips or progresses into over the next 3 to 5 months of like how they've landed the plane, like how the economy is humming for small businesses again. Immigration and crime is down. The border's secure. Like they sort of have threaded this needle in policy in a way that you're going to start seeing breadth widen. You're going to see, financing conditions, home affordabilities. I mean, we just got some of the best housing sales numbers since like 22. The stuff they're doing is sort of working.
Now you're making me nervous. But I guess my biggest, like, if I'm going to play devil's advocate on the bear side, it's that, yields are too low, vol is too low, and there could be some sort of like momentum reversal, short, yen carry trade unwind type scenario. Like that's, and I don't think that it derails the economic baseline of growth, but like just from a market's perspective, that bothers me. I will give you this, here's 2 things. Slide 42 first. This is Scott Rubner.
I was about to say we should just look at some of that stuff to try and sober ourselves and see how much runway we got. So yeah, hit us with the
and like I don't know, things can always happen geopolitically that throw a wrench in all this stuff. But this is Rubner. He used to be at Goldman, had a great email, concentrate on market structures and flows, and he said retail cash proportion of notional volume by month during October and November, that's definitely rising. And then if you look at retail options, they go up even more in October and November too. So like there must be some year-end seasonality type stuff going on, people getting bonuses, et cetera, in Q4. But then go to slide 41. This is a bit more on the derivative side of things. So this is what's fascinating. everyone's expecting the market to puke, like, oh, it's at all-time highs. We're a little bit bearish, like better buy some downside protection. But if you look at, okay, so historical vol is looking in the past. That's the orange line, 30-day historical volatility. That's at 8. And if you look at implied volatility, 1 month out, 30 days out, that's the white line. So there's still a spread between like realized vol, historical vol, and implied vol in the front month. So if you look at it, it's actually in the 84th percentile, which means like the market's barely moving. Actually, like it's just going like this every day, like slowly. But people keep buying, expecting there to be more volatility from an index perspective. And it's actually pays to get to sell vol here, forward vol relative to realized, because, it's still saying implied vol is expensive relative to realized. Does that make sense?
Yeah, because everyone's bidding up protection and there's no vol happening, but the bid for protection is still occurring. Yeah, totally. I mean, I look at a number of different things that gauge my, views, and we did just make it through a more treacherous period on liquidity. You see that in Bitcoin, the separation of Bitcoin relative performance. And so, the flows and liquidity and some of these factors, they do matter mechanically. And what I was kind of saying is like, it's so weird how this stuff always lines up around Q4 and the seasonality, and the memes just go wild and they seem to work every time. But I find that fascinating. On the dollar thing, just to finish there, you have record short dollars. Just people keep adding to short dollars positioning. And you have other parts of the world like Europe, Japan, going basically into like stagflation while the US is sort of accelerating here. I mean, give or take a month or two of like quote unquote economic bottom. But like that's my basis. And I think the dollar, like everybody's been shitting on it for so long every time, like, and Trump's helped that and Moran's helped that. And, we all know the games being played there, but it's very difficult with current positioning for the dollar to get weaker here. And I think we're entering a period where the U.S. economy is going to be much stronger than the rest of the world as we move out of these, the negative effects of all this policy change and into some of the better effects. I mean, we get the OBBB tax stuff starting next year as well. So that's pretty, like, U.S. stocks are levered U.S. dollars. Look, I think fiat's still shit. Like I still, like, if I'm a multi-year horizon, I'm still picking gold over dollars, but gold, look at what gold just did. Like, people are confused because gold just did what that move normally happens with everything else falling. But when you look at it on a relative basis, we might be coming out of a recession, inflecting economically over the next 6 months, and they're getting oil to keep plummeting, and they're getting industrial commodities to not, end the party. And so, simply put, like, are we going to tip into a nominal recession? No. Are we going to tip into even a real recession? No. Is inflation high? Yes. Is the Fed doing anything about it? No. Is inflation going to become a problem no matter how many stimulus checks they get, if they get the Saudis to pump every other month and price of commodities fall? No. So, like, that's where you get this melt up thing where the S&P just ticks 0.5% a day.
That's where the question is, all right, how much run do we have? There's a couple other charts I have from Rubner that I want to get into. I posted his article on Twitter, but yeah, he's publishing some stuff publicly now. So make sure you're always reading that. It's really, really good. How much runway do we have? Okay, so this is one of his charts looking at just basically leverage in equities right now. And you can see there was a meaningful tick up recently, but compared to that euphoria that we saw last November Trump election, like, we have plenty of runway to go. We're pretty neutral in terms of leverage.
That's great. That's a great chart.
Full targeting funds, they've returned to their same allocation before Liberation Day, but they're not extended. So they're right back where they were back in April. So wouldn't call that overheated, but obviously they're not playing the catch up bid, which has just been why we've been grinding higher so much, is full targeting funds and CTAs as well. So you can see they've rebuilt their positioning too. So all of these systematic stuff, like the systematic communism that Tyler talks about, they've rebuilt their positions now. So they're in it. You know, you're not early anymore into the rally, but they're not overheated either. And then corporate demand, I feel like Tyler right now, but now I'm going to be talking about corporate buybacks. They're on pause for a little bit, but they're coming up. And when are they coming back on? Right on time for SPY seasonality to tick up into the end of the year. So you have a little hiccup, you know, maybe mid-October, and then you're just off to the races into the end of the year. That was my best Tyler impression. I don't know. How'd I do?
Dude, you're becoming a market structure expert, and I'm becoming your CFA expert. Yeah, with roles of reverse.
There's runway. There's runway to this rally. I think we can agree there. Obviously, we're not early anymore, but
do you know what my worst fear is? To be the contra, where like I know we've been, you know, relatively bullish, but like I'm so bearish, I'm bullish. I gotta say that. Like when you look at all the problems around, there's really no way out, and it's. I feel like I'm beating a broken drum with all this market structure stuff, but that's the backbone of everything. My favorite is watching the mid curve hedge fund highly paid analysts analyze the earnings, and it's like, dude, just shut up, just ride the wave, shut up.
I mean,
things you hear at the top.
Yeah, seriously.
I know, right? I told you the valuation was too large. They was trading at 17 times EV/EBITDA.
It's just different investing because we're not in investing anymore. We're in a bubble, and it's not investing. It's momentum driven hot potato, which can last for years. I mean, it has in many other cases. But
yeah, would you say we're more at 1998 or like 2000? Because like we just started the easing cycle. Like if you think this is like Greenspan lowering rates and you're seeing foreigners pile into our equity market now, like is it early or is it late? I don't know.
I'm just taking it month by month, seeing what I'm seeing on the liquidity policy. I mean, policy changes every 3 weeks. So like you got to take that into account. And I think for me, it sort of boils down to like the simple, like most basically is how loud is recession? It's bothered me for a while. I got to listen to that George Robertson interview, Felix. I'm excited to listen to that because I know he's very recession camp. All of these problems, everybody's very aware of. It's like Main Street's been in a recession. All the chart, you know, AI CapEx has kept things afloat, yada, yada, yada. I think we are coming out of the recession for Main Street over the give or take a couple, 1 or 2 months. I don't know if it's last month or this month or next month, but I think the economy will, you know, is bolstered. And I think that in those cases for risk, you know, you have equities at all-time high valuations. That's not attractive. But for risks, basically, you need inflation to come back. And they're creating energy prices. So they're creating the Goldilocks for you. And that said, caveat, like you have to be paying attention. I'm bullish dollar. So maybe there's still liquidity issues on the horizon before they really get these cuts off or the Treasury does something. Or, you know, we're getting over 3% real GDP print while we're about to get a 3% plus inflation print. And so we're talking 6 nominal for the quarter. Like, and I'm looking at the 30-year trading at 4.7. That's pretty nasty. Like, so whenever the bond vigilant, like, I guess it's just whenever bond short positioning gets rinsed enough to find a sort of top in bonds, the low in yields, and people start wanting to put that trade back on, then you start having probably issues again. But yeah, it's like so far they're threading the needle. It's
check out IWM's, like it's like a 4-year cup and handle. Like this is JC Peretz. I got to give him credit. That guy is great with technicals. But if you look at IWM, it's saying exactly what you're saying, which is like we're about to accelerate here for the the smaller cap economy that has just been left out, and it could be like a serious breakout. We're watching.
I fully agree. I think we had the little recession in April, and it got papered over by AI capex build out and high interest payments going into money market funds, going into just rich people that can still keep spending, and floated like the top earners, the top income spenders are papering over that, K-shaped economy thing. And I think those two things papered it over, so it didn't look quite as obvious. But yeah, I think it's happened for Main Street.
Yeah, I mean, yeah, the chart says it. I mean, we were in a recession, and the only reason that little bump up to where it was because Trump's election, and then people realized the policy initiatives at the beginning. But yeah, I mean, if you see the Russell right now, it's set to close. Let's see, if it does, it's set to close above its 2021 and 2024 weekly all-time high closes. And if that's happening while every other index is at all-time high finishes too, like, and the yield curves, dead as a doornail, and oil's falling through this floor. I don't know.
You need a geopolitical spark to mess everything up. Next week we're gonna walk out of here. There's gonna be a 10% sell off and be like, damn.
Yeah, it's either geopolitics or some sort of bond route. Yeah,
we'll see. We're sounding too.
We'll see.
The one thing, like, there is, like, because we were going on, very firmly in the nothing ever happens camp of the shutdown earlier in the show. The caveat would be, like, my best bear case right now is that Trump investment see this final couple months as like the window to move some real hardcore policy changes through, and actually use this as like a very aggressive job cutting government reduction thing, whereby this shutdown is worse. And then you get that at a time when people are already on edge about the labor market, and you potentially get like a mini growth scare. But I don't know, man. Like, we just saw this week, right? We saw the labor data just continue to be brutal, like ugly, and market doesn't care and bonds don't care. So it tells me that everyone's looking forward to the liquidity and the fact that, like, we are probably in the process of bottoming on a lot of this data.
The only thing market structure wise I'd say is, like, if you look at single stock call volume, there's a lot of retail open interest there. You could see sort of like a day or two wipe out on some funky event there, but that's just a cleansing thing. I agree. If you just look at the structural backdrop, you really need earnings to roll over to be super bearish here, and we'll get that in a couple of weeks. So stay tuned.
That is a risk too with pass through, because we, margins are probably coming in, but again, like, that's margins for like Kohl's and JC Penney. Like, who cares? The S&P 500 is made up of not them.
Yeah. You can't tariff Facebook ads.
Yeah.
All right, guys. I think we can leave it there, but we did some good groundwork. We're all on the same side of the camp for once, but we're trying to be level-headed about it.
I want to know what's behind Quinn. It looks like his dorm room and all his clothes on his bed. Like, he just got home from spring break.
Yeah, it's doing some remodeling. So
I like it.
You get the blurred for now.
Yeah.
You actually want to see something I just got? Wait, dude, you're gonna laugh. These Crocs.
Oh, no. What are those?
Check those out.
Dude.
Those are your water shoes? What is that?
Yeah, dude. They're Crocs. Have you ever worn Crocs? They're comfy, but yeah. I mean, I'm like a hype beast, so I'm kidding. I'm not, but
can I ask this question?
These are cool.
Are these suburban house dad shoes? Like,
yes.
Yes.
Shit. I got someone roasted me like, "Hey, nice suburban house dad outfit." I'm like, God, I've hit that.
Go
stage.
Cubs! I'm wearing my Sammy Sosa shirt for Cubs Game 3 tonight.
I'm wearing my Oilers hat because hockey starts next week. So there we go. There's
Hockey starts next week. Holy shit!
Wow,
I know.
What the heck?
I'll be an Oilers fan this year for you, Felix.
Thank you. We got to re-sign McDavid. That's the most stressful part of my life right now.
I have no idea who that is.
He's the greatest hockey player since Gretzky.
Is he really? Oh shit!
Yeah, 100%.
Yeah, I see. I need more tutelage on this. I went through, when you have like small children, you just stop watching sports mostly, besides like Monday Night Football, because they're just biting you all day long. So anyway, we should cut it there.
All right, let's getting out of hand. Suddenly we'll turn into a hockey podcast.
Yeah. All right.
We'll see ya.
See ya.
See ya.